Hope everyone's doing well. This is the Emini review for Wednesday, May 29th, 2024. As always, let's start by looking at the daily chart. And so coming into the day, the market's in a tight trading range above the moving average here. We had that big bear bar, which was a surprise on the 23rd. And the expectation after that bar is a second leg down. And following that bar, we had two bars that went sideways. And on some smaller time frame, it's more clearly maybe a two-legged pullback. And so the expectations for me today, I thought we'd go lower, and I didn't know if it would be today or later. But I thought we'd have sellers above yesterday's high. Now coming into the day, if you looked at the Globex market, you could see the market was down about 15 points below the close, or 15 points below the low of the prior day, and down about 43 points from the close of yesterday to the open of today, which is about 0.8%, and that's a pretty sizable gap down. The pattern, it's not a perfect II pattern because Tuesday traded above Monday, but it's close enough and it will probably function like one. So my one concern with the gap down, even though we gapped down 15 points below the low of yesterday, I thought at a minimum we would come back and test the low of yesterday. Because it's basically an inside pattern, breakouts are low probability, and if there is a breakout, they usually pull back before long. And with that, I will draw yesterday's low. And the high is so far that I'll just not draw it. And one more thing that I found interesting, I like to do this once in a while. Whenever you have a big gap, you can think of gaps as breakouts. They function the same way. And so we have this big gap down, which can be seen as a big breakout. And so what I'll do sometimes is I'll try to visualize the gap by drawing a rectangle like this. And you can see it looks just like a breakout. And what I found interesting, we had that wedge yesterday, parabolic wedge, and look where we're testing on the open of the day. So I found that interesting. So with that in mind, we're on the bear channel line, and we're gapping down. It's a big gap down, but possibly climactic. And then bar one, we had a doji bear reversal bar. It's an implied pullback, low one short. And what I mean by that, an implied pullback is there's no technical pullback on this chart, but there was a pullback on a smaller time frame. And now we have a low one at support, the channel line. And so probably buyers below bar one. Bar one's a trading range bar, and after that big gap, the odds are there are sellers above. And we don't know where the sellers will come in, but also the odds are we have sellers above bar one. Bar two triggered. Let me zoom in a little. Bar two triggered the low one and then reversed up. So bar two is a bull reversal bar. After the gap down, the odds are we're not just going to rally straight up. But if you're short, you can get out above a bull bar closing near its high. We're so far from the moving average, and there is that chance that this channel line is support, and we could vacuum up to resistance like the low of yesterday, maybe the moving average. So bears might exit above bar two, but it's an aggressive stop order buy. And again, probably sellers above one. It's a small trading range on the open so far. And then three was an inside bar, bear trend bar, but again, it's an inside bar, so it's a non-breakout bar. So as strong as the bar looks, it's a bear bar closing near its low. The odds are there are buyers below bar 2. There might even be buyers on the close of bar 3. Bulls betting that the bears will not get follow through, selling. And then you can see on bar 4, we traded below bar 3 and reversed up. Now we have a second reversal on bar 4, so if bears were not going to exit above bar 2, they probably will exit above bar 4. But there was no stop order trigger above bar 2, so some traders will see bar 4 as the first reversal attempt. And so if we go above it, some bears may not exit above bar 4. Plus, it's a tight trading range. Every bar is overlapping the other. And when we're high in the range, there are sellers, so probably sellers above and buyers below. Bar 5 was a bull trend bar, breaking out of the tight trading range on the open. And it's a good breakout bar, but now the bulls need follow through. Any bear who sold above bar 4 or even bar 1, betting that it's a trading range, is currently trapped. But if it is a trading range, gaps will close. And again, what's most important here for the bulls is follow through on the next bar. And then look at bar 6. The bulls could not prevent bar 6 from closing as a bear bar, and so they could not do the minimum. So bar 6 made this a weak breakout. There is a micro gap from the high of bar 4 to the low of bar 6, but again, bar 6 being a bear bar damages the bull case and weakens that argument. It's strong enough up that it will probably get a second leg, and bar 6 is so small, the first reversal down will probably fail. But there is a risk in remaining long here if you are long. So I think bulls, they might exit below bar 6, but probably buyers somewhere below. And then outside bar 7. Bar 7 broke out further to the upside above bar 6 than below. But the main thing to remember is that outside bars are trading range bars. And so we have an expanding triangle on a smaller time frame. The odds are there are buyers below bar 7 and sellers above. The low one triggered below bar 6, but if you sold that and bar 7 is your entry bar, you're probably a disappointed bear. And you look to sell higher. And then bar 8, it's another doji. Not quite an outside bar, but basically the market is searching for direction. The bulls got a breakout and weak follow through, but the bears have been unable to close the gap. And there are gaps. They did test the bar 1 high gap on bar 8, but these gaps below are still open. And there still is a negative gap or a body gap. So even though the bar 8 low tested the bar 1 high, there's still a gap on the line chart because the line chart measures closes of bars. Probably more buyers below and sellers above. Was bar 8 the second leg up for the bulls? I don't know, probably not. Markets are fractal and they often repeat patterns. So you have a leg up here, then a pause, and some traders will call that a second leg. And you can call it a second leg. It's a spike break below bar 6, so technically a pullback, and then a bull bar, which went to new highs. But it's not symmetrical, so this could all be seen as one leg, and then we could get a deeper pullback before a second leg up. And for now, the bears, there's not much selling pressure, but we are far below the moving average, and the bulls are not getting what they need either. So probably going more sideways here. Inside bar on bar 9. So inside bars again, they are the non-breakout bars. The only thing, because bar 9 is a trend bar, it did break out of something. And the only thing it broke out of, you could say it broke out of the bar 8 close, the bar 8 open. Opens and closes, highs and lows of bars are magnets. They're important prices. So bar 9 did close above the close of bar 8, but it's an inside bar, and the market's in a tight trading range for the past 4 bars. And this was weak follow through for the bulls. So the bulls, they might get their second leg here, but I think the upside is limited. Bar 10, small bar, breaking out of the tight trading range, but not closing above the bars to the left. so that's a weak breakout. Bar 10 is a weak low 2 if you call bar 6 a low 1, and then a second reversal on bar 10, low 2, but 2 bull bars. You can call bar 10 a bear bar, closing below its midpoint, but it's a sell reversal bar, but it has a bull body, and that weakens the case for stop order bears. And this is still fairly tight up. You could say leg 1 and then trendline break leg 2. Maybe we'll test lower. Plus, this trading range is a magnet. Whenever the market is in a trading range, it's found a fair price. And so anytime it breaks out of that fair price, it's usually going to try to come back and test the middle of the trading range. And if it's a triangle, the apex of the triangle. So bar 10, maybe buyers below, but we're possibly high in a trading range. So the buyers may not come in until later, and probably sellers above. And then we had that outside bar on bar 11. Bar 11, it's obvious it broke out way further to the downside below bar 10 than above. So that's a more bearish outside bar. What the bulls have going for them, whenever bars have a tail, that's a failed breakout. So at one point, bar 11 was a bear bar closing on its low. And then the bulls, on some time frame, they got a 2-bar reversal. We see it in the form of a reversal bar. And so the bulls, they get a bull bar closing near its high, but overlapping many bars to the left, and possible second leg up, 1, pull back 2. Some traders might even call it 3 legs, up on 5, up on 7, and then up on 11. When you look at the first 11 bars of the day, are you saying, gosh, I gotta get long? Are you feeling urgency? Or is it more confusing? You can see a lot of bars are overlapping. There's not much of a sense of urgency. And it looks like we are trickling up to test resistance. Remember, the gap down functions like a breakout. So we had a big gap down. We're expecting a second leg down. But most breakouts get pullbacks. And so the market may be pulling back after that gap down, the breakout, before finding sellers above and a second leg down. And then for bar 11, what do you do? The problem with buying above bar 11 is, let's say you buy bar 11. One of the problems is your risk is big. So you buy above, stop below. Your 1-to-1 is here, and that's above yesterday's low, which is expected to be resistance. Plus you have to break out of the 5-minute moving average. So the odds are not 60% certain we're going to go up here before down here. And you cannot take a 1-to-1 trade with less than 60% probability. So there might be buyers above for a scalp, but I think the upside is limited, and we're going to run into sellers above at some point. This is a weak channel, and bull channels are bear flags. Bar 12, bull breakout, but closing at the high of the prior bar, so it could be much stronger. Some traders see this as a spike, but bar 11 going below bars, really all the bars to the left from bar 6 on, that really damages the bull case. This is not a micro channel, so now we have possibly 2 legs up here, 1, pull back 2, and a nested second leg, 1, pull back 2. Many traders probably won't sell below bar 12. It is 4 consecutive bull bars, or at least bull closes, and selling below bar 12 is low probability. Some traders might call it a low 3, low 1 below 6, low 2 below 10, low 3 below 12. But again, probably more buyers below and a little more to the upside before strong bears come in. And we could not trigger the sell below, and we went higher on 13. Another bull breakout, but failing to close above the bar to the left. Bar 12 could not close above the high of bar 12, and that's a sign of weakness. You see the market is testing the 5-minute moving average, the 20-bar moving average on the 5-minute chart, and the low of yesterday, which is expected to be resistance. But tight enough up, the first reversal down will probably fail. But as far as buying here, I would not. You might be buying high in a developing trading range. This looks like a couple of bull legs in a trading range. And what follows bull legs in a trading range is typically bear legs in a trading range and not a bull breakout. Bull breakout 14. And what do you notice about bar 14? Besides bar 5, it's the strongest bull bar of the day, and you could argue 11. But the point I'm making is after all these bars, look at the bodies of these bars. We're suddenly getting the biggest body on bar 14. And bar 14 is closing above the moving average, closing above the low of yesterday. But this is where weak bulls buy. You have bulls who didn't want to buy all the way up, think it's weak. Then finally you get this strong bar, and the weak bulls say, I gotta buy, it's gonna go. But the problem is, it's climactic, and you have tails above bars 12 and 13. You can call it a wedge on a smaller time frame, it's minor. But 14, the reality is, it's climactic, and it's a bar that strong bulls will take profits on, so strong bulls are selling. And it's a bar that strong bears will sell. We're at resistance, expecting a second leg down after the gap down. So you have strong bears and strong bulls selling here. So not ideal to be long. 15, you can see traders sold the close of 14 for all the reasons I was just saying. 14 was a gift for the bulls, so they took profits. And the bears, pretty much the same thing. They're getting to short at a better price in a weak channel at resistance. 15, inside bar, so lowers the probability for a breakout, but it's a strong inside bar. That's good for the bears. The first reversal down will probably fail, so probably find buyers below, but maybe not directly below. And even if they are directly below, the second leg up, so we are expecting a second leg for the bulls after this rally, but it could be very minor. It could be as small as one bar. And when you get a bar like 15, that's a problem for bulls. 16, so bad stop order below 15, inside bar, and first bear bar in maybe 6 or 7 bars. So buyers below. But now we have bar 16, a high 1. And if you've ever watched my other videos, you know what I say all the time about high 1s and low 1s. I said it on the open of the day. The problem is that if you're not early in the market cycle, and basically you're not getting a high 1 and a strong spike, then you're probably getting a high 1 later in the market cycle in a channel or trading range phase. And the odds are, with a high 1 in this case, there's probably more sellers above. Remember what happened on bars 14 and 15. The unfortunate bull that bought the high tick, or even the close of bar 14, got 15 for their entry bar. So if you were that bull, you got a 15, what are you thinking? You're thinking, darn, that's a bad entry bar, and I obviously bought too high. The market didn't go up, and so you'll probably use any chance you can get to exit at break even. Now you're getting a bar 16, and if you're fortunate enough, maybe you set your limit order at your original entry price, the high of 14, the close of 14, anywhere, somewhere up here. That's the point. That's why there are sellers above 16. And you can see what happened on 17. We've had 4 or 5 bars go sideways, so we're in a tight trading range, possible final flag. And like I said, had a couple legs up in what's probably a trading range. And if it is a trading range, you know that we're probably high in that trading range. And again, at yesterday's low, major resistance. So if anything, if you're a bull and you didn't exit below 15, probably wise to exit below 16. I think the upside here is limited, but tight enough rally. As weak as it was tight enough that the first reversal down will fail. Was 15 the first reversal? It was. But 17, there's not a major trend line break here, and that's the problem the bears have so far. You can call this the trend line. You can call this the trend line. Most of the bars touch this one. So we do have a minor trend line break. With 17, probably sellers above. going more sideways to down here. 18, bull reversal bar, but now a high 2, high in a trading range. The same problem as bar 16. So it's a strong looking bull bar, but pretty much completely below the moving average. Context is terrible. You're high in a trading range. If anything, just like with 16, I'm expecting sellers above bar 18. Most of the time by bar 18, the market has formed the high or the low of the day. One thing I forgot to mention, which I think was interesting, and I'll touch on it now. Well, first of all, have we seen the high or the low of the day? Right now, it's more likely we've seen the low of the day. But when you consider everything I'm saying, and you think about day structure, what's the day going to look like? Is it a small pullback trend? Are we going to rally all day? I will say this, the bulls have open gaps, and I'll draw those. So we had this open gap. We had another open gap above. Breakout above here. So the bulls have 2 open gaps, and that's good for the bulls. But when you look at the price action, you know it's weak. The context is bad, and you wonder, are the bulls going to keep those gaps open, or are we in a trading range and you know those gaps might close? So with bar 18, maybe 50% chance we've seen the low of the day. But the more selling pressure we get, the more bars that get added to the day, we'll get more information, and it may become more and more likely we've seen an early high of the day. So what I was going to mention is that most bars have tails. So if you think about the daily chart right now, and the bar on the daily chart, there's a really small tail below the bar, and it would be really unusual to get a bull trend day, considering the context coming into the day, and considering the fact that there's barely a tail below the bar. So what might be forming here is the upper part of the tail of the bar. So we might have a tail, here's the open, we have a tail above, and then we come back down. Remember also, most days are trading range days, and so far this is not a very strong looking bull trend. So with bar 18, probably sellers above, going more sideways. 19, bear bar, again probably more sellers above. For the bulls, they'll argue it's a wedge bull flag. 1, 2, 3 pushes down, and then the bulls are hoping they buy here, and we go for a measured move up based on the wedge bull flag. Again, the bulls need to do more here to convince me that we're in a bull trend. Keep in mind the gaps below, because those are magnets. And then you can see 20, we sold off fairly strongly on bar 20. Bar 20 was strong enough that it'll probably get a second leg. Now bar 20 is definitely a trend line break. Here's a bull trend line. Market's clearly breaking that trend line. So the problem with selling here, first of all, you're at a gap. Really any of these bars over here, if bears got trapped, they're getting a chance to exit. So there might be bears buying on bar 20. And the bulls, they'll argue it's a bear breakout of a bear channel, so low probability of a strong breakout. More likely, we have this rally, then a trend line break, and then some retest of the trend's extreme. Again, I'm going to keep the low of yesterday drawn. It's close enough to the price I'm talking about, the high of the rally. So the highest probability event here is, yeah, this is a decent minor reversal, but it's minor. And we'll probably have to go back up here and test these prices before there's any major reversal. So what do you do on bar 20? It's still a minor reversal. It's a low probability sell. It is a strong enough bar, you know it's probably getting a second leg. Some bulls draw the trend line like that, and we have the first bar breaking that trend line, so the bears still need follow through. And then bar 21, they get it. So at this point, if you're a bull and you did not exit up here, and then you get this sell off to bar 21, you're obviously disappointed. And that's what creates major trend reversals. You have bears who didn't sell, betting that there wasn't or at least thinking there wasn't enough selling pressure up here. Possible final flag, but maybe not enough. Then we get this bear breakout, which is fairly strong. There's a little overlap. We have a micro gap between here and here. The odds are this is getting a second leg. But you have bulls trapped into bad longs up here. You have bears trapped who didn't short. Do the bears want to short in the middle of a trading range, low in a spike, or do they want to sell higher? Obviously, they want to sell higher, and that would be the retest of the trend's extreme. It's a micro channel since 19. The odds are there are sellers above, but because we're in a trading range, the pullback could be really deep. And then 22 was the end of the spike phase. So bar 22, small bull reversal bar, unlikely that it... Well, think about it. Is this going to undo all of this? Probably not. The first reversal up will probably fail, and even if we do go higher, the odds are there are sellers above. And then a bull bar 23. Bull bar closing on its high. One of the risks is that it's maybe a 50% pullback of the sell-off. So we have the sell-off. You can see we're around 50%, and that's resistance. But now we've had 2 consecutive bull bars closing near their highs. It's probably going to get some sort of second leg. And the odds are we're going to test higher up here. But because of this breakout, the odds were it would get a second leg. The odds still are it'll get a second leg. But this is disappointing for the bears. 24, bear reversal bar, low one short, but bad location. Especially after 2 bull bars. Probably more buyers below. The bulls will likely get a second leg. You do have bears trapped if bears were selling the close of 21 because of the 2 bar rally. So probably support below. And then 25, you can see we tested the close of 21 and bounced. So any bear that sold here, scaled in higher, they're exiting. This 2 bars down, probably just a pullback of this. But it's confusing. The market is in a trading range. And you can draw a triangle. But the most important thing to know is that the market's in a trading range. And it's breakout mode. So as far as 25, weak stop order buy, so probably more sellers above. But there were bears who got trapped on the 21 close, getting a retest on 25. So their buying might contribute to a second leg up here. 26 bull bar, but completely below the moving average. And again, bad stop order above 25. And then was 26 strong enough to keep you in the trade? I don't know. It's not closing on its high. It's not breaking out above the moving average or the bar 24 high. The bulls are hoping it's a double bottom and we get a breakout of the neckline above the high of 24 and go for a measured move up here. Even if we go here, the odds are there are sellers above. So I think the upside is limited. We might be high in a trading range up here. Hard to buy above 26 when you're at resistance, the moving average, and after this sell-off, it's likely sellers above. Maybe leg 1, pullback, leg 2. Maybe we go a little higher, but I do suspect there are sellers above. Inside bar 27, so not breaking out, lowers the probability of breakouts, buyers below, sellers above. And then 28, broke out below 27, and then had a tail, could not close below. So possible 2 legs down here before a rally. It's possible this was leg 1, more complex 2-legged pullback, and then the bulls get a second leg up, which would mean 26. Remember again, patterns are nested, so 26 could be seen as a second leg, but it can also be seen as a pullback between the leg down from bar 24 to 25, so leg 1, pullback, leg 2. Do the bears want to sell here? Well, ask yourself when you look at the price action. Bears trapped here on these 2 bars, They got a chance to exit on 25. They took it, and then the market's retesting that price, and we're getting weak bear bars that are small, overlapping, and tails below. So probably buyers below. And then bar 29, bull trend bar, but in the middle of a tight trading range, forcing you to buy at resistance. So hard to buy here. It is a triangle. It's breakout mode. Some traders might argue we had a sell-off, then a tight trading range, so final flag, and then a reversal up. But this is the more major pattern. We had this weak rally, testing the low of yesterday, then the sell-off, which will still probably get a second leg. Was 24 and 25 the second leg? Probably not. Similar to bar 7 over here. Was that the second leg? I don't think so. And then we had this more complex two-legged pullback before a more symmetrical second leg. So I think we'll have something more similar to that over here. Leg 1, maybe complex pullback. Still might have to test the trend's extreme. And then second leg. A couple of reasons why I think we're going to test higher. The market's in a trading range. And even if bars 19 through 21 is a strong leg 1 breakout, expected to get a second leg, the problem with breakouts in trading ranges is you get deep pullbacks and second legs are delayed. Plus, major trend reversal pattern, we had a bull trend line break, and more likely we get some sort of, whether it's a higher high, double top, or lower high, double top. We're probably going to test higher and find strong bears selling above and bulls who are trapped up here selling out of longs. 30, you can see no one really wanted to buy above bar 29. As strong as of a bar as it was, you're in the middle of a tight trading range at resistance, the high of the trading range, the 5-minute 20 EMA. But bar 30, is it a strong sell setup? Of course not. Some traders will argue 3 legs sideways, it's a wedge, bear flag, and then a second leg. But if 30 is your signal bar and you're selling below, you need a really strong entry bar. And we're low in a trading range here where bears keep exiting. Bears may have exited here and then got trapped if they didn't. Exited here, exited here. Bears are not looking to sell down here. They're looking to sell higher. 31 triggered the low 3, but it wasn't the bar the bears needed to hold short if they shorted below bar 30. So because of that, I think more likely we might find buyers on the close of 31 and below 31. Low in a trading range, a lot of overlapping bars, breakouts are failing. And then 32, small inside bar, but probably buyers below, and hard to sell above in this context. 33, a second leg down for the bears. So the bears hoping it's leg 1, pullback, leg 2, but the problem here, doji, bear bar with the tail, pause bar, an inside bull bar, and then another bear bar, but look where it is. Testing the low of 22, which is support, the low of a trading range. Do you really want to sell bar 33? As strong of a bar as it looks, it's not above average size, and you can call it a second leg down. With this, leg 1, pause, leg 2, you can say leg 1, pullback, leg 2, bottom of a trading range. This rally, still expected to get a second leg, maybe 1, pullback 2, before buyers come in. And that's what happened on 34. Bull outside bar, trading below 33, trapping weak bears, and then reversing up, closing on its high. If you're short, it's a credible stop order above 34, so it's an always in. You have to get out of shorts above 34. Bulls they can buy, looking for a swing. But again, the context is bad because of this resistance above. 34 is also a big bar and forcing you to trade in the middle or upper third of a tight trading range. But overall, might just be 2 legs down, and then this is the high of the overall trading range. Follow through buying on 35. So you had bulls buying above, you have bears exiting shorts above. We're going higher. But 35 is a smaller bar than 34, and that's a sign of weakness. The bulls really wanted 35 to look like bar 34, and instead it's a small bar finding a resistance at this tight trading range high. Strong enough up, probably leg 1, and probably going to find buyers below and a second leg up. 36 continuing up, probably going to find buyers below. 3-bar micro channel, micro gap from the high of 34 to the low of 36. But 36, obviously a weaker bar, almost more of a trading range bar with a small body and big tails. And now we're getting high in the range, and you know that there are bulls who are disappointed up here, looking to sell out of longs, and bears who did not catch this breakout, expecting a second leg down, and looking to sell above. Inside bar 37 reduces the probability for breakouts, probably sellers above. And then 38. 37 is a pause bar, so it could separate two legs, one leg, pause, 2, but it's tight enough that the first reversal down will probably fail. But as far as being long here, I think it's dangerous because it could be leg 1, pullback, leg 2, high in a trading range, and possible major trend reversal setup. 39, the problem with being long, high in a trading range. Now you get 39. If you bought, it doesn't matter if you bought the high tick of 38, you need to exit longs below 39. 39 is an always in flip. Doesn't mean we're going to just sell off and get this double top major trend reversal, but that risk does exist. It's hard to argue staying long. You can argue tight bull channel, pull back, probably get a second leg, and that's true. But the second leg could be really minor. It could be 1 bar, and it could even be the tail of 1 bar. For 39, it's true, it's the first reversal down, so lower probability. But again, I still think if you're long, reasonable to exit longs below 39 and reasonable stop order short below 39. One of the problems with major trend reversals, especially on a day like this, the range is small. It's a trading range day, a lot of bars overlapping. The problem with major trend reversals, only 40% become major trend reversals. 60% of the time, you either get a continuation up or you get a trading range. And I think the most likely scenario here is a trading range. Inside bar 40, but that could be the second leg that the bulls get after this rally. Leg 1, pull back, leg 2. You can see where bar 40 tested. It tested the high close of this rally, the bar 38 close, and then found sellers. Weak stop order sell, but still probably better to be out of longs below either of these bars. I think it's dangerous to hold long here. Probably high in a trading range. Also, look at the moving average on the 5-minute chart. Probably 90% of the bars are below the moving average. Also, keep in mind the big gap down. Expected to get a second leg. Possible leg 1, pullback. Leg 2, complex pullback before a second leg into the second half of the day. And that's what the bears are looking for. Coming up on bar 40 and 41. So we have 81 bars in the day on the 5-minute chart. So this is the time where bears would be looking for a reversal. And it is a major trend reversal setup. Bull trend, trend line break, test of the highs, and the bears are looking to get short here for a swing. Because of all the trading range price action, reduces the probability that we'll just get a strong bear trend. But I still think the best case scenario for the bulls here is a trading range, so probably wise to not be long up here. 41, another bull breakout, testing the low of yesterday once again, but again, really dangerous to be long here. 41, unable to close above the low of yesterday. It's a bull bar, but a lot of overlap and a big tail above, probably sellers above. It's a second leg up as well, and a nested second leg. And then 42, if you're a bull looking for a breakout here, I mean, it's clear that the bulls are not getting what they need. The bulls needed a bar like 34, closing well above the low of yesterday, and then a follow-through bar, ideally looking like 34. And instead, they're just poking above the resistance. What I think is more likely here is that the bears are in control. We're high in the trading range, strong bears are selling above bars, and then you get 42, an inside bar, probably sellers above, and context is always important. So usually I would say buyers below, and that still could be true, but I would not buy below bar 42. And then 43, bear breakout. The problem with the inside bar 42, there's usually buyers below, but when you take into consideration the context of the entire day, you know you're high in a trading range after 2 legs up, plus you're at the resistance low of yesterday. Bear breakout 43, not the strongest bar in the world, but it did close below the moving average, and it moved a fair distance below 42. So any bull who bought below 42, or even bought below 41 and 40, are trapped. Probably going to get a second leg down and sellers above. No follow through for the bears, so bear breakout, no follow through 42 or 44. But now 44 is a high one at the top of a trading range, probably more sellers above, and they may not be directly above the bar, they may be up here where bulls got trapped, the 42 low, maybe the close of 41, somewhere up here. Instead we got a bear bar, inside bar 45. It's a minor second leg, so leg 1, pause, leg 2, but could all be one leg. It's a micro channel since 41, so 5 bar micro channel, probably sellers above. We've had a couple legs up for the bulls, and the bulls are unable to get the breakout. And again, what happens after bull legs in trading ranges is you typically get bear legs in trading ranges. You might be high in the range up here. This might be the start of a second leg down, maybe leg 1, pull back, leg 2, or leg 1, pull back, leg 2. 46, obviously a weak stop order buy above. It's a micro double bottom with 44, but completely below the moving average. Terrible context to be buying. Sellers above. Bull bar 47, but unable to break above the moving average. Sellers above. Maybe buyers below, but if you are buying below, you have to ask yourself, what's your premise? You're buying in the middle of a trading range. After a couple bull legs up, the odds are we're going to lower. 48 bull breakout, but possibly a vacuum test of resistance. Remember that low of 42? Bulls got trapped buying there. 48 could be simply testing that price, and 48 is more of a sell the close bar than a buy the close bar because the context is bad. 48 is overlapping all these bars to the left, high in a trading range, and possible leg 1 pullback, leg 2. So we might go a little higher, but dangerous to be long here. And that's exactly what happened on 49. Any bull who got long below 42, disappointed. They're taking anything they can get. They couldn't even get back to their entry price. And it's unlikely that 49 just sold off in the first seconds of the bar. I wasn't watching, but what probably happened was 49 opened, and it opened at the close of 48. You can see these small tails above. The market tried to break out above 48. No one was willing to buy above 48. So the market was stalling at that high price. I don't know how long. I'm assuming maybe a minute or so before everyone started to sell out of longs and bears. We had this breakout. Bears are selling a pullback. 48 is kind of a gift. Strong bear bar 49. Get out of longs below 49. Probably going lower. But tight trading range here. Possible buyers below 46. And then the bears got another bar, but there were buyers below 46, which is a trading range. But in the overall structure of the day, the low of the trading range could be all the way down here. Remember I said by bar 18, 80% chance we've seen the high or the low of the day. And by bar 42, probably more likely we've seen the low. But if you consider the context and everything I've been saying, the reality is it probably was not more than 50% that we've seen the high or the low. And then you get the sell-off and continuation down. Now the odds that we've seen the low of the day, I don't know, maybe 40%, and then for the high of the day, probably increasing. What do you do on 50? No one wants to buy above bar 50 after the bulls just got trapped on the 48 close. There are trapped bulls below 42, and those trapped bulls are fuel. What I mean by that is at some point, the risk is going to get too big. The bulls aren't going to want to scale in, and they'll be forced to liquidate their positions. They'll be forced to exit, and they'll look to buy again lower. And then 50, strong bear bar, and then follow through. But 50 was an inside bar, so not breaking out. And then 50 was a weak breakout bar, but you really want to buy above 50. A couple of bear bars, you can call it a double bottom, maybe 3 pushes down here, but the context is bad, and there's probably sellers above. The 48 close is a magnet. We may have to test there before we go lower. 51 going lower, so if you bought the close of 48 and this is your follow through after 15 minutes, you're probably wondering, are we going to get back here? Or is it possible we go for a measured move in the opposite direction? This is the problem for the bulls right now. We could easily come back down here before we come back up here. For the bears, 4-bar micro channel, probably sellers above and at the moving average. Inside bar 52 lowers the probability, and like I said, probably sellers above. Possible leg 1, pullback, leg 2, but this was strong enough for its own second leg. And then a bull vacuum test of resistance once again. So this is a surprise, bar 53, but it's testing the low of yesterday. As strong as this bar is, it's really just within the trading range. Bears got 2 legs. We're getting a correction. But I think the bar like 53 is like 48, and it's like 14, and it's like any of these bull bars in here. As strong as it looks, the context is really bad to be buying. So if you're long on 53, you have to ask yourself what your premise is. And the reality is the risk reward is bad. And if the market does not continue quickly, traders will exit their positions. Here's the 1-to-1. Is it clear we're going up here before we close the gap? Of course not. So now we have an open gap above 52. And what do we know about gaps in trading ranges? Most of them close. So you will have bears seeing leg 1 pull back, leg 2. So some bears, it's aggressive, but they'll sell the close of 53. Other bears will wait for a small second leg because 53 was enough of a surprise that it may get a second leg. But there's that increased risk that it's a second leg trap at resistance. So as far as being long here, I would not be buying. 54, the bulls could not break out above the high of the day. 54 is a low 1 at the top of a trading range, so not the worst trade in the world, but after the 2 bull bars, probably need a second reversal, probably sellers above 54. High 1 above 55, you know what I'm going to say, probably sellers above, and it's 55 is almost a bar that it doesn't get triggered sometimes. It's almost like it's an obvious trade. The high 1 above 55, sellers above, and it's almost greedy to set a limit order above. I don't know if it triggered, but it's oftentimes you see that high 1 limit order trade not trigger, and instead they sell the close of 55. And then we did trade above, so, and again, I don't know the order, I wasn't watching, but possible we traded above 55, triggered the high 1, and then sold off. But now we have an outside bar 56, expanding triangle at the top of a trading range, probably sellers above. And as far as buying below, I would not. The context is bad. Inside bar 57, so IOI. Inside bar 55, outside 56, inside 57, sellers above, and possibly sellers below. It's breakout mode. 58, a bear trend bar, breaking out below 57 and closing below, but unable to close below 56 in the moving average. But as far as being long or buying above 58, obviously there's probably more sellers above. 59, a small bull reversal bar. Some bulls might see strong leg, two-legged pullback, and then a high 2 above 59. But it's a high 2 at the top of a trading range. The context is terrible to be buying, probably sellers above. And then we went outside down 60. So if any bull was still long, they'll probably exit below bar 60. And at this point, we have a gap here in a trading range. Odds are we're going at least a little lower, closing that gap. 61 went a little lower and possibly went for a 1-to-1 of the bar or something like that, maybe close. 2 legs down, leg 1, pause, leg 2, and a pullback, but really tight channel, probably sellers above. And we're still, as far as this trading range goes, if this is the low or in the middle of the trading range, we've had bull legs up, now we've had 1 bear leg down. Some traders might call it 2 legs, but this looks more like a pullback in the bull legs. So we had a rally, 2-legged pullback, and then a second leg trap. Now we're getting a more orderly bear breakout. It's not strong. It has overlapping bars. It has a bull bar, tails below. So it's not the strongest breakout in the world, but it is expected to get a second leg, probably sellers above. Inside bar 62, another bear bar. Hard to find a reason to buy. The bulls are hoping we test 51, somewhere in this area, and get a double bottom. Maybe bears were trapped selling above 51, and they were. But what happened when we retested? Did we bounce? No, we tested it, went below it, closed even below it, and now we're going below it further. So bears were not sufficiently disappointed. And again, like I said, it's tight enough down that the first reversal will probably be minor, and we'll probably get a second leg down. 63, outside bull bar, but obviously there were sellers above. Why did it go so high? Because it's a weak bear breakout in a trading range. So traders aren't going to sell down here. They're going to sell a pullback. This one might have pulled back 60%. So here's 50%, here's 70. We're between it. Traders sold at about 65% pullback of this bear leg. 63 is enough of a surprise that it may get a second leg. But the problem is it's counter to the direction of the bigger trend. This leg down is leg 1. Here's your pullback, which may get a second leg before another leg down. So as far as buying here, you're buying for a scalp, and it's dangerous to do. I would be looking to short. 63 couldn't close above the moving average, and more than half the bars below the moving average. That weakens the case for the bulls. Probably sellers above and may have to go more sideways to up before the second leg. And instead, traders sold a close of 63. So 64, a bear trend bar, still a tight bear channel, but bull bars inside, and that weakens the case for the bears. And now we're low in this trading range, possibly buyers below, and there were 64s finding support. But do you want to buy the close of 64? I'm not sure. There's less overlap. You can see space here. So we have control over time and price by the bears. Again, not as strong as it could be, but we do have negative gaps. The 59 low or the 59 open, and then bodies to the left, maybe the close of 63 or the open of 61. There's space between those bars. So on the line chart, that's a gap. Some traders might argue leg 1, pull back leg 2, but still tight enough to be one leg. Probably sellers above, but bad location to sell, so we might have to go higher. 65 inside bar, lowers the probability for buying, probably sellers above, but maybe not directly above. And then 66, we went above 65 and found sellers. Low one short below 66, but the context is bad. Not a very strong bear breakout, and low in a trading range. Probably buyers below. 67, another inside bull bar, possible breakout, and then one leg, pause, second leg, testing where bulls got trapped. The 63 close, but we're having a hard time getting there, and eventually the bulls might give up. If there's a second reversal down, they may give up on the trade. And then that's 68. Might be sellers below 68, but it's a doji, 4 or 5 bar type trading range, so probably sellers above, buyers below. When you look at this day, you know it's a trading range day. You know gaps close on trading range days, and there is an open gap here. Traders are wondering if we're going to go a little lower and test this gap before we reverse back up. Outside bar 69, it's a strong bar, but the context is bad. Possible leg 1, pause leg 2, pause leg 3. Outside bars are trading range bars. It's an expanding triangle. It's an outside pattern. So bar 68 was outside 67. And then of course 69 was outside 68. Probably more sellers above. Plus the magnet below. And then disappointment, bar 70. So if you're a bull and you're front running the breakout on 69 and then you get bar 70, you might just give up on the trade and look to buy lower. Instead, we got a bull breakout, 71. But possible buy vacuum test of resistance. Getting high in the range, not ideal to be buying here. Still overlapping all the bars to the left. Plus, this was leg 1, and then we're getting a pullback, maybe a second leg down for the bears. 72, testing the low of yesterday once again, and then finding sellers. This is not, you have to, even though it's a breakout bar 70, 69, and 71, you have to ask yourself, what's the market breaking out of? And you can see we're inside a trading range. The bulls want these bars, but they want them closing way up here, above the trading range. But instead, they're coming within the trading range. Now we're high in the trading range. So more likely, sellers above, more sellers, and going sideways here. Sellers above 72. Strong enough up, we'll probably get a second leg. Buyers below. 73, there are the buyers below. And now 73, high 1, you know what I'm going to say. Probably sellers above. They may not come in until the low of yesterday. They may come in right above 73. And we may not even trigger the stop order above 73. Probably sellers above. Vacuum test of the low of yesterday once again. On 74, it's a bull breakout and a bull trend bar, but closing at the low of yesterday and still within the trading range. Possible leg 1, pullback leg 2. Tight enough that the first reversal down probably will fail. But 72 could have been the first reversal, a low 1, trendline break. And then if 75 is weak for the bulls, we might have a second entry short setup. And that's what 75 is. Big bear trend bar, closing near its low. Another one of those bars that you need to respect for always in flips. If you're long, even if you bought the close of 74, if you bought anywhere, I would get out of longs below 75. Too much risk of going lower. We're high in a trading range. We're getting a second reversal down. We're at resistance. Follow through selling 76. So far good for the bears. Strong signal bar, strong entry bar. One of the problems is it's a possible pullback from the rally. So here's your rally. We're at about 70%, which is a common pullback level that traders will buy. But traders are not huge fans of buying strong breakouts like 75 and 76. Little overlap and big bodies. Plus it could have been 2 or 3 legs up for the bulls, 69, 71, 72, or 74. Now we're getting a reversal and we're not down here, which means there's room to the downside in this trading range. And then more selling, 77. 77 is breaking out of many bars to the left. It's testing this line, which was the gap over here. If bears got trapped early in the day, scaled in higher, they could avoid a loss and make money. 3 bar breakout, but late in the day, still within the trading range, so it's possible this is a sell vacuum test of support and not a strong bear breakout, but strong enough down, the odds are it's probably sellers above, and the first reversal up will be minor. Some traders look at this as 3 legs down, possible wedge, and it is characteristic of wedges where the third leg is the strongest leg. So would not be the craziest thing in the world if this reversed up, because it's the end of the day on trading range day at support. But I think it's really aggressive to buy the 77 close. 78, you can see we went a little lower, but then we're low in the trading range. Bears are taking profits, strong bulls are buying, and then we get a bull bar closing on its high. Again, it's still probably minor. The odds are we're not going to just rally up. But again, so late in the day, with only maybe 2 or 3 bars left, probably better to do nothing. Strong enough bar, it'll probably get a second leg, and the expectation is maybe a small second leg, and then a second leg down for the bears. Instead, we found sellers above 78, and that could be the second leg down for the bears. Again, maybe 2 legs down at support, probably buyers below. Follow through selling, bar 80. Probably sellers above, but hard to sell above and hard to be short here at the bottom of a trading range. And then 81, we went a little lower, but the bodies are shrinking. This is not a strong bear breakout. We're still within the trading range. For always in today, it's always difficult on trading range days to call the always in. We had the big gap down, and then the minimum followed through on bar 1, so it's probably always in short bar 1. But bar 1 was also a bad low 1, so not ideal to be short. And then maybe on bar 5, it became always in long. And then for the bulls, really no reason to exit until bar 15 or bar 17 if you want a second reversal. Did it become always in short here? It may have briefly, but in general, on a day like this, with all the overlap and the big up, big down, usually better to not think in terms of always in and think in terms of buy low, sell high, and scalp. So even if it did become always in short here, it probably became always in short at the worst time. So when it becomes always in short, it's time to buy. Same thing with over here. If it did become always in long, which I think I said above 34, reasonable stop order, so probably always in long, either the close of 34 or the close of 35, but hard to stay long at the top of the trading range at yesterday's low resistance. And it's the same all through here. If it ever became always in short, it became always in short at the worst time. Was 53 always in long? I don't think so. It's buy low, sell high, buy vacuum test of resistance. More traders selling the close of 53. Tight bear channel, but low in the range. So probably if it did become always in long or always in short here, it became always in short at the worst time. Again, really hard to call it. I don't think we're always in long here. I don't think we're always in short here. I think it's buy low, sell high. So up here, look to sell. Down here, look to buy. Weak rally with pauses. I don't know if it ever became always in long. And you know what I'm going to say. If it did become always in long, it became always in long at the worst time, the high of a trading range. Buy low, sell high. And then here, I thought 75 was an always in, respectable stop order trade. So probably good to get out of longs below 75. 76 confirms that, so always in short. But then you get down here, you're low in the trading range. Hard to hold on to shorts in a tight trading range. For stop orders, bar 4 was a second reversal up. Technically a first reversal. Some traders see it as a second reversal. We're far below the moving average after a gap down, so some traders will buy, hoping for a trend from the open, but not the best with the tail above bar 4. And then as far as through here, I don't know, hard to buy above bar 9, an inside bar in a tight trading range. Hard to buy above bar 11, big risk, bad context. 15, it's an aggressive sell below because this was so tight. You know we're probably getting a second leg. But after we get that second leg, I thought selling bar 17 was not the worst trade in the world. What about all through here? I don't know about stop orders through here. I think the next best stop order was above 34. And then up here, second reversal down, 42. Weak signal bar, but I did say it's an inside bar, and typically for inside bars, it's sellers above and buyers below. But up here, I would not be buying below. So reasonable stop order below 42. Couple legs down, probably buyers above 52. And then up here, second reversal 57. Okay to sell below 57. It's a weak signal bar. And then through here, it's so tight, it's usually better to trade with limit orders. Couple legs down, but tight channel, so hard to buy above 65, but you are low in a trading range. It's not the worst trade in the world. 69, it's an outside bar, expanding triangle, below the moving average, hard to buy. And then again, 75, probably the next best stop order trade. For limit orders, I kind of talked about them throughout the day. Buyers below bar 1, buyers below 3. I thought sellers above 1, scaling in higher, and if they did, they had a chance to exit on bar 8 or bar 11. Thought sellers above here, scaling in higher. Eventually here, probably buyers below. But then you get 15. It's not ideal to be buying below a bar like 15, but there were buyers below for that small second leg. 16, high 1, bad context, sellers above. I thought buyers below 24, but maybe not directly below, maybe at the close of 21. All through here, it's a limit order market, tight trading range, sellers above bars, buyers below bars. Then you get 34, really dangerous to sell above 34. And then up here, high 1 above 40, probably sellers above. Couple legs down, but micro channel, so probably sellers above, but bad context, bad location to sell in the middle of a trading range, so sellers above, but probably higher. And they came in here, above bar 44, or on the close of 48. Same thing here, sellers above, but bad context here, and they came in higher, above this lower high. And then up here, another bad high 155, sellers above. Sellers above this weak reversal attempt, high in a trading range. 63 was a bad low 1, probably buyers below, low in a trading range. And then in here, limit order market, sellers above, buyers below, but you're low in this range. Eventually, you get a bar like 69. Hard to sell above a bar like 69. And if you did, and your entry bar is 70, everybody bailed out of the trade. 73, high 1, but bad context, so sellers above. And then through here, I thought sellers above 78, but hard to sell above a bar like 78. As always, please feel free to leave questions in the comments and include timestamps with any question specific to this video. Alright, hope everyone has a good rest of their night.